So your mortgage has gone up dramatically and you're struggling to cope. I get it and I've got you. In this video, I'll show you 7 ways to help you cope with the increase in your mortgage payment. Let's get straight into it. Number 1, speak to your lender. You'll have heard this before, and I'm sure your lender's probably sent you loads of emails and loads of communications telling you to reach out. But you need to hear this, because lenders like banks and building societies have a responsibility to help you if you actually reach out and ask them for help. In the UK, mortgage providers are obliged to help their customers who are struggling with payments. And they've got a myriad of options at their disposal, from the very simple ones to those that are more complex. So you reach out to your lender, tell them you're in difficulty, and let them tell you what they can do for you in your circumstances. Remember, just by reaching out doesn't oblige you to take on any of the options they provide, but at least you know what is on offer and, more importantly, what isn't. If you've not done this before, I know you might be thinking that lenders may just look at this in a bad way and actually pressurize you into making payments. And that's pressure you don't need because you're already feeling that financial pressure. But that's not reality. As I said before, UK lenders are obliged to help their customers who tell them and come to them telling them that they are struggling with payments. And lenders who do not do this will be hit with penalties from the regulators. So number 2 applies to you if you're on a repayment mortgage. Now, if you're on a repayment mortgage, the chances are you're paying more than someone on an interest-only mortgage. And that's because your monthly payment is made up of 2 parts. One part pays the interest for that month on that mortgage loan, and the second part has a repayment component which pays back the capital on your mortgage loan. So if you're struggling over the next few months to meet your mortgage payments, or even on an ongoing basis, then it might make sense for you to shift yourself to an interest-only mortgage, therefore saving yourself from the repayment element. Now, of course, at the end of a mortgage term, you do have to pay back the capital balance, but that is a longer term problem. Now, don't ignore this because paying back a mortgage is your responsibility, so you do need to pay back your balance at the end of a term. But if that term is 15, 20, 25, 30 years away, it's not really going to affect you in the next 6 to 12 months where you're really feeling the financial pinch in your day-to-day affairs. Number 3 is similar. This time I'm going to talk about your mortgage payment term. So when you took out your mortgage, you agreed with your bank, building society, or other financial lender that you would pay this money back over a period of time. Now, typically for a mortgage, that's going to be 20, 25, 30-ish years. I know you can get lifetime mortgages, you can get some shorter mortgages as well, but generally they're between 20 and 30 years. Now, you may be in a position where you're 15 years into your mortgage term and you might have moved house a lot, you might have ported your mortgages across, you may have already lived in your property for 10 plus years. In this case, your mortgage term, you may already be 10 years into a 30-year mortgage term, for example. And if you're in a position like this, then you can ask your lender to increase your mortgage term, maybe to 30 years again. And so what that does effectively is it resets your mortgage term to that longer period of time. But it also means that your payments are stretched, they're spread over that new term. So rather than now being spread over 15 years or 20 years, however much you've got left in your mortgage, you're resetting it over 25 or 30 years. So your payments naturally come down. Now, this does mean that the amount of interest you pay over the full mortgage term will go up. But again, in this video, we're not really dealing with that matter. What we're really trying to do is help you cope with the increase in mortgage payments in the here and now over the next 6, 12, maybe 18 months or so. In the short term, this does give you one option with which to reduce your monthly outgoings. So tip number 4 applies to those people who have been in the fortunate position to be able to overpay their mortgage or have had the foresight to overpay their mortgage when they could. So this means that they've been paying back more than their monthly mortgage commitment is. So say you took out a mortgage in 2015 and your mortgage commitment to your lender was £1,200 a month. So this was very affordable. But in 2016, maybe you got a pay rise, maybe you switched jobs and took on a big new salary. And rather than stick to your £1,200 a month commitment, you took the opportunity to pay back an additional £200 every month. So instead of £1,200, you are now paying £1,400. So that means that your credit balance on your mortgage grew by £200 a month. And actually, it wasn't really a credit balance, but what it meant was that your mortgage capital reduced by £200 a month, reducing the overall interest you were paying back on a month-by-month basis and overall as well. Now, fast forward to now, you are struggling with mortgage payments, but you've built up quite a big overpayment history. So with that overpayment balance that you've got, you can actually ring up your lender and say, I've made a lot of overpayments over the past few years and I'd like to take advantage of a lot of them. Now I'm in financial difficulty, I'd like to actually take some payment holidays or reduce my monthly payment by taking those into account. Most lenders, and in fact I can't think of a single one that actually wouldn't do this, would allow you to use that overpayment balance to reduce your monthly mortgage payments from now on in. And again, that's another thing to help you cope with the increases in mortgage payments that you're now seeing. Now, of course, this will eat into your overpayment balance, and so you may want to replenish that in the future, but it is certainly an option to help you meet the increased costs in the short term. Number 5 is what I like to call savings transfer. Now, this is where I will talk a bit about a false economy. So say you have £10,000 in the bank as savings. At the moment, it's probably earning anywhere between 3 or 4% of interest, of savings interest. So you're thinking, great, I'm earning on that £10,000 probably £300 to £400 a month, a year in terms of interest. Great, thumbs up. But if you're paying 6% on your mortgage, then that's a bit of a false economy. You're earning 3 to 4%, but you're paying out 6%. And I know what you're probably thinking. Your £10,000 of savings is a drop in the ocean compared to the size of your mortgage. Let's say you have £150,000 as a mortgage. How is your £10,000 of savings going to affect your £150,000 mortgage loan balance? Well, it isn't completely. Clearly, £10,000 is less than £150,000, but the percentage is what you've got to focus on here. Let's just take that £10,000. That £10,000, as we said, is earning you £300 to £400, depending on the interest rate you're earning on your savings. If you're earning anything at all, you may even have that £10,000 sitting in a current account, in which case this is even more of a no-brainer. But let's say you've been smart and you put it into a high-interest savings account at earning 3 to 4%. So that means you're earning £300 to £400 a year. You've taken out a mortgage of £150,000. So on a £10,000 basis, let's do it like for like with the savings that you've got, you are paying 6% as your mortgage interest rate. So that means you're paying £600 a year on that £10,000. You're earning 300 to 400, you're paying 600. Does that make sense to you? If you put that £10,000 directly into your mortgage, then that could mean that you're not losing £200 a month. You're not earning £300 to £400 a month on your savings, correct? But you're also not paying £600 out, so you're making a net saving overall. And a quick note, don't just do that if you've got that £10,000. Speak to your lender because you don't want to have unintended consequences of paying an early repayment charge, which may or may not apply to your particular circumstances. For the purposes of simplicity, I'm going to ignore any early repayment charges or other factors here and purely think about if you've got £10,000 in savings earning a lower rate of interest than what you're paying out in your mortgage. Then you might want to transfer that and put it straight into your mortgage and reduce your overall mortgage balance, which not only helps you in the years to come, but actually saves you in the short, medium and long term as well. And I know some of you will be thinking, but that £10,000 is cash that I would have available if an opportunity were to arise. If those opportunities, those things in the future that you can't predict, don't arise, then you're wasting money on a month-by-month basis. And in these times when your mortgage rate is increased, it's especially important to be financially prudent and making sure they are doing the best for your overall financial health. So this is number 6, and this time we're talking about being smart in your other spend areas. I talk about this on another video, but the key things to be mindful of are your regular spend areas. Are they as low as they can be? When did you last negotiate your TV package, your mobile bill, or your broadband? When did you last negotiate your other regular payments that go out? Look at your current account, look at your direct debits and standing orders. Where are your regular payments going? When was the last time you negotiated them? Do you just automatically renew? Getting smart in your regular spend areas could save you hundreds of thousands of pounds over the short, medium and long term again. And more so at the moment, because if you're seeing these massive increases in mortgage costs, then every penny counts. And it's likely to be way more than just a penny towards helping you meet those increased mortgage payments. For those of you who are on your first mortgage or have been on your first mortgage for a while, remember what we've had over the last decade or so is historically low interest rates. There are those that believe that those low interest rates will return, some that believe that we're only going up. But regardless of what you think about the long term, in the short to medium term, mortgage rates are likely to stay where they are or increase even a little more from where they are now. So being more savvy about how you spend, particularly on your regular payments, and making sure you negotiate those regular spend areas with those providers will make sure you're getting the biggest bang for your buck and you are making prudent spend choices that can increase the amount of money you have available to put towards your mortgage in the near term. So all of the things I've talked about so far are the things that you should absolutely be considering to help you cope with your mortgage payment. But over the longer term, you need to make sure that you are on a good mortgage deal. And this is where tip number 7 comes in getting into bed with a mortgage broker. Figuratively, of course. I've used many over the years in handling my property portfolio, and I know that some mortgage brokers are better than others. What you want to do is find a whole of the market mortgage broker. And this type of broker does exactly what it says on the tin. They survey the whole of the market. Once you know you've got a whole of the market broker, the next thing to consider is whether they charge a fee or not. Some do, some don't. I typically use a fee-free whole of the market broker if my needs are relatively simple. So if I've been in employment for 2 years, got 2 years worth of employment history, and it's a simple remortgage I'm doing, or something very simple that doesn't need a lot of complex thought, then I don't see the point in paying a couple of £100 when there are free ones out there that can do the same job in the same way. However, there are times when a fee charging mortgage broker can make sense. And this is when your situation might be more complex. I have a relationship with a mortgage broker, for example, which has been going on for many years. And when my needs are more complex, he will be the first person I call. And this will be in a situation such as when I started a new job, for example, or I've started a new business and I don't have sufficient trading history to show a lender that I can service a mortgage. Or in situations like the one I had recently, where one of my properties is not let directly to the people that live in them. It's let to a company who then lets to its staff. So it's a company let. I don't have an assured short hold tenancy with the tenants directly. It's a company let agreement that I have. And in those situations, a more nuanced approach is necessary. So I need to leverage the experience and knowledge my broker has in dealing with the mortgage market and those providers specifically who are better tailored towards those that let to companies as opposed to let to individuals directly. And over time, just like savings and growth compounds, your relationship with the broker compounds. Over a period of time, they will start to understand what your overall financial position is and what your goals and aspirations are. So a fee-free whole of the market mortgage broker if your needs are relatively straightforward, and consider a fee charging mortgage broker, again, whole of the market mortgage broker, if your needs are slightly more complex. Of course, be aware there are a few large lenders that don't deal with brokers at all, but again, your mortgage broker, fee free or fee charging, will be able to advise on those. They won't be able to do that mortgage for you, but they'll be able to advise on which ones those are, and you might want to compare directly with those yourself. One quick thing before we end the video. If you found any of these coping strategies useful, please consider liking and subscribing to the channel. It really does help the channel grow and reach a wider audience. Thanks for doing that. So as promised, these were 7 ways to help you cope with your mortgage and help you overall with your financial position. I hope these have been useful to you. If you'd like to hear about my top 5 money tips, then click on this video next. Otherwise, I'll see you on the next one.